Ladies and gentlemen, we are standing at the edge of an economic moment that is capturing the attention of investors, policymakers, and everyday Americans. A storm is gathering, and many believe that something huge is coming from President Trump, a policy shift, an announcement, a direction that could send waves through the financial world. But it's not just political momentum that has the markets buzzing, it's the Federal Reserve. For years, the Fed's decisions have shaped the value of our currency, the direction of our interest rates, and the strength or fragility of our economic foundations. And now all eyes are on its next move. Why? Because the stakes have never been higher. When people say that something major may be coming from President Trump, what they are really describing is the sense of anticipation and uncertainty that naturally forms around a political figure with a large influence on national policy and public sentiment. Whether one supports him or not, it is undeniable that his announcements, especially on matters such as economic policy, trade, taxation, or regulatory direction, tend to generate strong reactions across financial markets. Investors, analysts, and everyday citizens often watch closely, not because they know what will happen, but because they understand that his decisions or statements can shift expectations, reshape the national conversation, and signal possible changes in the broader economy. The possibility of a major upcoming move creates a psychological environment where people brace for impact, even before any concrete information is released. This anticipation stems from the fact that political leadership plays a crucial role in guiding economic direction. When a president or former president indicates that something significant is on the horizon, through speeches, interviews, social media, or campaign positions, it activates a chain reaction in the markets. Traders begin analyzing potential implications. Will this announcement affect taxes? Could it influence federal spending? Might it signal a change in how the government views inflation, industry regulations, or geopolitical strategy? Because policy shifts can meaningfully affect business conditions and consumer confidence, markets adopt a cautious posture until clarity emerges. This caution can manifest as increased market volatility, fluctuations in risk appetite, and heightened attention to safe haven assets. The phrase "something huge is coming" taps into a deeper reality of how uncertainty drives economic behavior. Investors dislike unpredictability. So when a political figure known for bold or unconventional decisions suggests that change may be imminent, many people prepare for the possibility that the economic landscape could shift, perhaps suddenly. This isn't about predicting a specific action. It's about understanding that anticipation alone can be powerful. The financial world doesn't wait for events to unfold. It reacts to signals, hints, and possibilities. Even the suggestion of major policy movement can cause shifts in sentiment as people try to position themselves ahead of time. This environment of expectation also reflects the current climate of economic sensitivity. Inflation concerns, discussions about federal debt, debates over interest rates, and global economic uncertainty all create a setting where people are particularly attentive to political cues. In such a climate, any potential announcement related to economic strategy becomes magnified. Market participants begin asking themselves what such an announcement could mean. Will there be new incentives for certain industries? Could there be shifts in trade agreements? Might there be proposals that influence the strength of the dollar? These questions reflect how interconnected political narratives and economic outcomes have become. Moreover, discussions about something huge coming aren't just about forecasting. They are about sentiment. Sentiment, how people feel about the future, plays a large role in financial behavior. If people believe that a major policy shift might occur, they may become more cautious, more strategic, or more speculative depending on their outlook. Some may scale back risk, while others may look for opportunities that could arise from potential changes. This is how economic psychology works. Uncertainty breeds preparation, and preparation shapes market movement. Ultimately, the idea that a major move could emerge from President Trump symbolizes more than a political moment. It represents the broader reality that leadership decisions hold the power to reshape expectations across the entire financial landscape. In an interconnected world where markets react instantly to headlines, the anticipation of forthcoming actions can be nearly as influential as the actions themselves. The Federal Reserve's upcoming decision carries significant weight because it sits at the center of the country's financial system. Every move it makes, whether raising interest rates, lowering them, or holding steady, ripples through virtually every part of the economy. This is why investors, institutions, and everyday Americans pay such close attention. At a time when inflation concerns remain present, national debt continues to rise, and global economic conditions are shifting, the Fed's choice isn't just another routine policy adjustment. It becomes a moment that could influence borrowing costs, business investment, consumer spending, and the stability of the U.S. dollar itself. When the Fed prepares for a major decision, analysts examine a variety of economic indicators: inflation data, employment numbers, manufacturing trends, global commodity prices, and the health of the financial markets. Each of these metrics interact with one another and influence the direction the Fed may take. The complexity of this environment increases the stakes. For instance, if inflation remains elevated, the Fed might be pressured to maintain higher interest rates to cool down the economy. Higher rates affect everything from mortgage payments to car loans to credit card interest. They also influence how businesses plan for the future. Higher borrowing costs can slow hiring, reduce expansions, or delay new projects. At the same time, rising rates can strengthen the dollar, which then affects international trade and global markets. But the opposite is also true. If the Fed perceives the economy weakening, they may consider reducing rates or signaling a more accommodative stance. Lower rates tend to stimulate spending and investment, but they can also weaken the dollar and raise concerns about future inflation. This delicate balancing act means that whatever the Fed decides, it will likely create winners and losers across the economic landscape. Another important factor is the psychological influence the Fed holds. Markets don't just react to what the Fed does. They react to what they think the Fed will do. This means that a large portion of the market's behavior is driven by expectations. Stocks, bonds, commodities, and currencies all move in anticipation of future conditions. If the Fed hints at a shift toward looser policy, investors may begin reallocating funds into riskier assets or hard assets like gold and silver. If the Fed signals tighter policy, investors may move towards safer instruments, such as treasury bonds. The anticipation itself creates volatility and opportunity, even before any actual policy change occurs. The global dimension adds another layer. The U.S. economy is deeply interconnected with international markets. When the Federal Reserve adjusts interest rates, it affects capital flows around the world. Higher rates in the U.S. attract foreign investment seeking higher returns, while lower rates can push investment elsewhere. This influences exchange rates, trade balances, and the economic stability of other nations. Countries with their own inflation challenges or fragile financial systems may experience pressure simply because of a decision made by the U.S. central bank. In moments of heightened political and economic tension, the Fed's decisions become even more scrutinized. People look for clues in every public statement, press conference, and economic report. Because the Fed operates independently from the political sphere, its decisions can sometimes counter the direction of political messaging or campaign promises. This creates a dynamic in which the market is constantly trying to interpret the interplay between political expectations and central bank policy. Ultimately, the Fed's upcoming move is significant because it will set the tone for the next phase of the economy. Whether it brings relief, uncertainty, or new challenges, the consequences will be felt in households, businesses, global markets, and the broader financial system. Throughout history, gold and silver have occupied a unique and enduring place in the financial system, not merely because they are physical commodities, but because they represent something deeper: stability in a world that often feels uncertain. Whenever economic instability rises, whether from inflation, political tension, market volatility, or global conflict, people instinctively search for assets that cannot be easily manipulated, printed, or devalued. Gold and silver fit this need perfectly. Their value is not determined by the policy decisions of governments or central banks. Instead, it arises from scarcity, universal acceptance, and thousands of years of human trust. That long history shapes the way investors view these metals. During periods of turmoil, when confidence in financial systems begins to weaken, gold and silver function as psychological anchors. They offer a sense of grounding when the future feels unpredictable. Unlike paper currencies, which can be influenced by debt levels, inflationary pressure, or monetary policy, precious metals maintain an intrinsic appeal rooted in permanence. Investors understand that gold has preserved value through wars, regime changes, currency collapses, and global recessions. Silver, while more volatile, holds a similar place in people's minds. This historical reliability is why both metals are considered safe haven assets. In moments of uncertainty, money flows toward them because they stand outside the mechanisms that often create instability. Another major reason gold and silver rise in importance is the nature of trust. Modern financial systems are built on confidence that governments will honor their debts, that central banks will manage inflation responsibly, and that the global economy will remain stable enough for commerce to flourish. When any of these pillars waver, the desire for something tangible increases. People may not fully understand complex economic indicators or debt cycles, but they intuitively grasp that a physical asset like gold cannot be printed into worthlessness. This simple truth often drives large movements of capital during unstable periods. Furthermore, gold and silver serve as hedges against inflation. When the purchasing power of a currency declines, hard assets tend to retain or grow in value. Investors often turn to metals as a way to preserve wealth when they fear that the value of their money is eroding. This is not just theoretical. History is filled with examples where inflation, or even hyperinflation, destroyed the value of national currencies, yet gold retained its power. Because of this, many view precious metals as a form of insurance rather than speculation. Another factor that increases their importance is global interconnectedness. Today's markets are deeply intertwined, which means a crisis in one region can quickly spill into others. When geopolitical tensions rise or when major economies face recession risks, global investors often seek universal assets that are not tied to any single nation's fate. Gold and silver are recognized across borders and cultures, making them especially appealing during worldwide instability. They are one of the few assets that can be stored anonymously, transported easily, and liquidated almost anywhere on Earth. Finally, the psychological component should not be underestimated. Market behavior is influenced not only by data, but by emotion, fear, uncertainty, and the instinct to protect wealth. Gold and silver benefit from this emotional dimension. When people feel uncertain, they tend to gravitate toward what feels timeless and unchanging. Precious metals symbolize permanence in a world where markets and policies can shift overnight. This symbolic value reinforces their role as safe havens. In all these ways, gold and silver rise in importance during periods of uncertainty, not simply because of their physical properties, but because they represent security when confidence in the broader system falters. When the Federal Reserve begins signaling a shift in policy, whether through speeches, economic projections, or changes in interest rates, investors around the world immediately begin repositioning their portfolios. One of the most significant reactions occurs in the markets for gold and silver. These metals have a long history of serving as hedges against currency weakness and inflation, which means that when the dollar shows signs of potential decline, or when monetary policy becomes more accommodative, interest in precious metals often surges. The connection is rooted in both economic logic and investor psychology. When paper currencies lose purchasing power, hard assets gain appeal. If the Federal Reserve chooses to ease monetary policy, such as by lowering interest rates or signaling a willingness to support economic growth through liquidity measures. The dollar can weaken relative to other currencies. Lower rates reduce the return investors can earn on dollar-denominated assets, like U.S. Treasuries, which can lead international investors to seek alternatives. A weaker dollar tends to benefit gold and silver because these metals are priced in dollars globally. When the value of the dollar falls, the price of these metals typically rises both because they become cheaper in other currencies and because investors look for stores of value that aren't dependent on central bank decisions. This dynamic is especially strong during times when people worry about inflation. Policy easing is often interpreted as a sign that the central bank is prioritizing economic growth over tight control of inflation. Even the expectation of higher inflation can drive interest in gold and silver, as these metals have historically been used to protect purchasing power. Unlike paper money, they cannot be created at will, and their supply grows slowly over time. This scarcity makes them attractive when people believe inflation may erode the value of their savings or investments. But it isn't only the economic fundamentals that drive demand. It's also about sentiment and narrative. When investors hear that the Federal Reserve may begin loosening policy, a narrative takes shape. The dollar may weaken, inflation could rise, and markets might become more volatile. Narratives are powerful forces in financial markets, sometimes even more influential than the data itself. If enough investors believe that gold and silver are about to become more valuable, their collective movement can create a self-reinforcing cycle. More people buy metals, prices rise, and rising prices attract even more investors seeking safety or profit. Another important factor is diversification. When central banks shift policy, the stock and bond markets often react sharply. Stocks may rise on the expectation of cheaper borrowing or fall on the fear that easing reflects underlying economic weakness. Bond yields may swing as investors anticipate changing inflation levels. In such an unstable environment, gold and silver offer diversification benefits because their price movements are not directly tied to corporate profitability or government debt levels. Many investors allocate part of their portfolio to precious metals specifically to balance the risks of economic or monetary uncertainty. The global perspective also amplifies the effect. In many countries, people view gold and silver not just as investments, but as cultural wealth. In regions where currencies have weakened dramatically in the past, such as parts of Asia, Latin America, and the Middle East, precious metals remain trusted stores of value. When the Federal Reserve signals policies that could weaken the dollar or disrupt global markets, demand from these regions can increase significantly. This international dimension means that the reaction to Fed policy is not limited to U.S. investors, but becomes a worldwide shift in sentiment. Ultimately, the idea that the Fed's next move could transform the trajectory of gold and silver prices is rooted in a simple truth. These metals react strongly to changes in monetary policy, inflation expectations, and currency strength. When people sense that the financial system may be entering a new phase, especially one involving easier money or a declining dollar, they often turn toward assets that offer protection from uncertainty and long-term preservation of value. Gold and silver have played that role for centuries, and they continue to do so today. Periods of economic transition always carry some element of uncertainty, and uncertainty naturally divides perspectives. When people sense that major monetary or political shifts may be ahead, they begin to evaluate risks and opportunities differently. This is why moments like the Federal Reserve preparing to change course or major political figures signaling new policy directions can produce such wide-ranging reactions. Some individuals immediately worry about the potential downsides, rising inflation, weakening currency values, market volatility, or disruptions to business conditions. Others see the exact same environment as fertile ground for opportunity, believing that change opens doors for strategic positioning, alternative investments, or long-term wealth preservation. The divide isn't simply about optimism or pessimism. It's about how people interpret economic signals and what they believe the future will reward. Risk itself is not inherently negative. In the financial world, risk and opportunity are two sides of the same coin. A market environment with no movement, no uncertainty, and no shifts usually produces limited potential for gains. It's the periods of tension, when policies may shift, currencies may fluctuate, or commodities may realign, that often create the largest openings for growth. Investors who understand this dynamic remain alert during transitional phases, recognizing that volatility can be used to their advantage if approached with knowledge and discipline. Meanwhile, those who are uneasy about sudden changes may step back, preferring stability and predictability. Neither viewpoint is right or wrong. They simply reflect different strategies for navigating complex economic terrain. During moments of anticipated change, the key is not to fear uncertainty, but to understand it. Economic shifts tend to reveal where vulnerabilities exist, such as over-leveraged markets or unsustainable debt positions. At the same time, they expose areas where value may have been overlooked, like undervalued commodities, defensive industries, or assets that tend to perform well during inflationary periods. People who focus solely on the risks may miss the signals pointing toward emerging opportunities, while those who chase opportunities recklessly can overlook hidden dangers. The balance lies in maintaining awareness and staying informed, watching how markets react not just to actual events, but also to expectations about what might come next. When the possibility of significant policy changes becomes part of the public conversation, many investors adopt a more strategic mindset. They begin preparing for multiple scenarios. What happens if inflation rises again? What if the dollar weakens? What if interest rates fall faster than expected? Each of these paths carries its own set of risks and chances for gain. For example, if inflation returns, assets like gold and silver may surge. If monetary policy becomes more supportive, growth stocks or emerging markets might benefit. The variations are endless, and this is exactly why such periods generate both anxiety and excitement. Another important factor is that economic transitions test emotional resilience. People often underestimate how much psychology influences financial decisions. Fear can cause individuals to sell too quickly or become paralyzed, missing valuable opportunities. Overconfidence, on the other hand, can lead to careless moves based on assumptions rather than analysis. Recognizing the emotional element of market reactions allows people to remain calm and rational even when headlines sound dramatic. Those who manage their emotions most effectively often navigate uncertainty better than those who possess technical knowledge alone. What ultimately determines whether people see risk or opportunity in these moments is their time frame. Short-term thinkers may feel pressured by volatility, focusing on immediate market swings. Long-term thinkers see beyond the turbulence and realize that major transitions often reshape the financial landscape in ways that reward patience and informed positioning. Gold, silver, real assets, or strategic investments may all play a role depending on how the situation unfolds. But regardless of individual strategy, the central idea remains unchanged. Periods of potential change always offer pathways to either protect wealth or grow it. In this sense, uncertainty is not a signal to retreat. It is a signal to pay attention. The environment ahead may contain risks that require caution, but it also holds possibilities that could redefine opportunities for those who observe carefully and act thoughtfully. Staying informed and vigilant during periods of economic uncertainty is more than just good advice. It is a mindset that helps people navigate change with confidence rather than fear. When major decisions are expected from institutions like the Federal Reserve, or when political signals suggest that big announcements may be on the horizon, the flow of information becomes critical. Markets respond not only to events themselves, but to expectations, rumors, forecasts, and interpretations. This means that individuals who actively follow reliable information sources are better equipped to understand what is happening and why. They can separate noise from meaningful signals and make decisions based on analysis rather than emotion. Being informed also means understanding that economic conditions rarely shift overnight. They evolve. The signs of change rising in inflation, weakening currency strength, Growing volatility in financial markets, shifts in commodity prices often appear in small ways before the full impact becomes obvious. Those who remain alert can detect these early indicators and adjust their strategies accordingly. For example, someone paying attention to interest rate trends or Federal Reserve statements may prepare for possible policy easing before it becomes mainstream news. This preparation can make the difference between reacting to a situation and anticipating it. Remaining vigilant does not mean living in a constant state of worry. Instead, it means adopting an attitude of awareness. It means recognizing that the economy functions like a complex ecosystem where decisions in one area can influence many others. A change in monetary policy can affect the value of the dollar, which then influences commodity prices, global trade relationships, and even geopolitical stability. Vigilance helps people understand these connections so they can position themselves wisely. When individuals know how one decision can ripple through the system, they are less likely to be caught off guard by sudden market shifts. Another key part of vigilance is questioning assumptions. During moments of economic transition, many people rely on outdated beliefs about what the market should do. But financial environments change, often dramatically. A policy response that worked in one decade may be less effective in another. An asset that used to offer stability may lose value if fundamental conditions shift. Staying alert means constantly reevaluating the landscape and avoiding complacency. It means being willing to adapt strategies when evidence suggests the ground is moving. Vigilance also involves recognizing that information is not all equal. Headlines can be dramatic, predictions can be exaggerated, and commentary can be biased. People who want to navigate uncertain periods effectively must rely on credible sources, diverse viewpoints, and data rather than speculation. This discipline helps prevent emotional overreactions, whether panic or overconfidence, and encourages decisions rooted in logic. When individuals analyze information rather than absorb it blindly, they build resilience. They are less likely to be influenced by fear-driven narratives or sensational forecasts. Finally, staying informed and vigilant empowers people. It gives them a sense of agency in situations that might otherwise feel overwhelming. Economic transitions are inevitable. They are part of the natural cycle of growth, correction, and renewal. But people who remain aware and educated gain an advantage. They can protect their savings, identify opportunities, and make thoughtful decisions even when the future appears uncertain. They understand that the economy is not a force to fear, but a system to navigate. In this way, vigilance becomes more than a practical habit. It becomes a strategic mindset. Rather than being surprised by change, individuals who stay informed are prepared for it. They recognize that uncertainty brings both challenges and possibilities, and they position themselves with clarity, confidence, and a steady hand.